Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Joyce, Managing Director on the Nasdaq Market Intelligence Desk, and Dr. Preston Cherry, founder of Concurrent Wealth Management and author of Wealth in the Key of Life. We're here to discuss market timing and the role behavioral finance plays. It is great to have the both of you with us, as always. Preston, you were here about 5-6 weeks ago, and the conversation was certainly different than the one we're going to have today, that's for sure. Yeah,
for sure. It's a little bit more, well, when we were talking a couple months ago, it was a little bit more muted and calm, and we had a little bit more certainty in the market and the economy. Now, just unprecedented uncertainty.
Yeah. Even in terms of the volumes and what we're seeing day to day, I can imagine some of the conversations that you're having with your clients, you know, as a financial and wealth advisor. It's got to be a little bit challenging when you're trying to work behavioral finance into that conversation.
Yes, even with some normalcy, right? These are challenging times when you have so much volatility in market. I mean, I think the VIX is up to 40 or something like that right now, right? So over 30 is anything that's, you know, quite giving you pause. So, you know, our clients have been educated through these types of volatility markets. That said, the unprecedented of the president's tariff activity, which is pretty much just self-imposed, that's what's causing a lot of the unrest.
Yeah, and Brian, there are some things that have to come back into equilibrium. I think the challenge is understanding what that end goal is and then the execution of that. And I think that's what still has markets rattled despite the move this morning where it opened up sharply higher.
Yeah, I mean, there's certainly, the VIX is representing, the extreme amount of uncertainty that, corporations are facing on how to deploy CapEx, on what to expect on future consumer spending, employment, and going into, I would say this post inauguration period, we did see some cracks a little bit in the economy and in the stock market, where maybe housing was looking to roll over a little bit. The home builders, have really been in decline since mid to late October. By early December, they were down 20% off their highs. And so I think there were some other areas, maybe a weaker consumer, certainly not negative growth in the economy at that point in time. But, I think what we're dealing with now with tariffs and all the uncertainty, comes when maybe the economy and the market was maybe, after that phenomenal 2-year run, we haven't seen that in 25 plus years. Yeah. Maybe the market, was overdue for a pullback, now getting that pullback, and a lot more with that.
Well, by the way, the past couple of years were anomalies. It's not that you get 20 to 30% return on the indexes multiple years in a row. I think the big tell more near term is we're coming into earnings season, and that's where forward guidance is probably going to be more critical. If companies are even able to provide guidance in this operating environment, I think that's, perhaps why the rally faded a bit today, and just kind of waiting to see what the fundamentals could look like.
Yeah, and today's fade in the market, it's hard to call the day-to-day squiggles, particularly hour by hour. The last couple of FOMCs, when you talk about corporate earnings, but the last couple of FOMC meetings, Jerome Powell, really was heavy on using the term uncertainty, and I would probably expect we'll hear a lot of that coming from C-suite management teams as well.
Yeah.
This earnings season.
Yeah, I would imagine, going back to behavioral finance, and your doctorate's in behavioral.
It's in financial planning, but I study psychology.
I was going to say, I'm sure there's a lot of empirical evidence to support how investors approach this, and it's almost like they capitulate when the bottom comes in. And you have a note on here when you think about the 10 best and worst days. It's still impossible to time these markets.
It is impossible. And one of the things is recency bias, like as you mentioned, which is the last couple of years have been anomalies, right? So, 8 to 12 to 15%, those are normal. And when you get back-to-back 20 years, everybody's like, yay, I want to buy the biggest growth stock that's out there, the Magnificent Seven. Everything's going to go up all the time. And so that's very recent. Right? And so we need to zoom out, right? Zoom out a little bit and say 10, 15 years, well, what does the normal markets look like, so to speak? And now that we're having some of this uncertainty with the president inauguration coming through, and then the numbers weren't that bad as far as economic numbers. And we needed enough time or a little bit more runway to order those numbers to stick, and then we just shook it up again with the tariffs.
Yeah, but because if you remove the noise, the data hasn't been that bad. I mean, even earnings last quarter, fundamentals were not that bad. It's just the realm of uncertainty, which, if you don't understand your operating environment, that's understandable. But, the economy, jobs, and spending were strong.
Right. I mean, inflation is kind of tepid a little bit as well. Like you said, jobs. But now if you're going to shake up prices, the PPI is creeping up a little bit. So now those tariffs are going to roll through the companies. Prices, households have already been strained a little bit with their budgets. The top 10% of earners could support 50% of the spending in this country. So income challenged folks, they're going to have a problem with higher prices, and then those with higher incomes, they're going to make substitution effects.
Yeah,
So,
I think it'll be interesting to see, how it plays out when it comes to discretionary spend. Brian, let's take a look at some charts. Let's get some confirmation from what the technicals are showing. Make it basic, make it easy. S&P 500, whether it's longer term and helping to tell that story of why longer term investors remain in the market.
Certainly. I mean, so we've blown through all of the near-term support levels. The 200-day moving average is, typically, in loose terms, to say the end-all be-all. And when price gets below that, there's a comment saying nothing happens good below the 200-day average. And so that happened about a month ago. And so we've now actually come within just a couple of ticks of the 21 high in the stock market, which is around 48.19 for the S&P 500. So we're seeing some stability there, very short term. And so that's a level I'm watching. And just below that is the 200-week moving average, and that's around 46.71. So in percentage terms, it's really not far below from where we are right now. That 200-week is typically a long-term indicator that we can often see hold as a low. We saw that in 2022, almost to the penny, and back in 2018, almost exactly to the penny. We did get below that very short term during COVID.
Right.
That was when we shut down the economy.
What was the low in 2022? When around that time?
That was October 22.
Okay, right. November 2022 is when we started getting that narrative around generative AI, and that's been the story over the past couple of years, which is why you saw multiples get to the levels that they did because of the promise and the investment thesis behind it. So it makes sense when you look at it from that perspective. This is when things took off in November 2022.
Yeah, and I think what may be different now is we had we were fighting inflation in 22 into 2023, but at the same time, other parts of the government were maybe trying to support the economy, and so we can maybe have some sort of a balancing act. And now it seems like, where's the put? Where's the Fed
right.
put? Jerome Powell was just speaking on Friday. He's comfortable with growth right now. He's trying to balancing out inflation effects that are still, they're closer to where they want it to be, but still not at their goal. So he's not necessarily right now. If you're thinking, hey, maybe what's taking place is going to lead to a recession, you'd want the Fed to be not reactionary, but maybe get out in front of that. It sounds like they're more on the reactionary side.
Yeah, well, I mean, we have to recalibrate our expectations too, Preston, right? I mean, think about it. So there are a generation of investors and traders who have not experienced a prolonged market with volatility since, the financial crisis. So it's a matter of, recalibrating your expectations and kind of, learning some market history here. It's easier said than done, and there is some pain, but again, past couple of years were an anomaly.
Right, absolutely. And the younger generation and even the current generation, political risk is normal, geopolitical risk is normal. So these are some normal shocks to the market. But that said, unprecedented, the COVID, right, the global pandemic, and then we have policy just as preemptive.
Right.
So now, particularly the younger generation, now they're getting to see that it's not game on all the time. And then folks that are in, 4 or 5 years outside of retirement and getting in retirement, right? Now we're talking about sequence of return risk, and they're like, it happened again, right? So
well, that's right. I mean, if you think about it, 15 years before, when they were like, let's call it mid 40s, early 50s.
Yes.
And now they're coming towards the end. I mean, at least they had some time to make that up from the financial crisis.
Right. We're going to have some, again, with some runway. I call it some runway in order for these, I guess the vanilla policies that are like interest rates and all that. Let's give it some months. And so hopefully the tariff policy shakes out. Well, that's a hope.
Right.
And it shakes off, get it off the table. That way, like you said, these businesses can make more outlook on their earnings and forecasting, and then that's where the confidence levels start coming back in. Right now, it's not there.
Yeah, and you know what though, the market's always going to climb a wall of worry. These things happen like every 10, 15 years. It's like in The Godfather when they say these things need to happen every 5, 10 years, right?
Right.
So, we will be looking at, some other kind of shock a few years out, and this kind of lends to, working with an advisor and keeping that long-term investor mindset, because at some point these valuations where you've been looking for more attractive entry points, they're getting more and more attractive. So
Right.
it's going to be start it's going to, at some point, you're going to have to put that cash to work.
Absolutely. I mean, there's times for everything. So right now, folks that are in a particular life stage, and also they have capacity as far as their budgets and where they are in time horizon. Those are going to really be key in whether you're raising cash in order to wade the waters, or you're using your cash to deploy for opportunistic investing, or even tax loss harvesting right now in your brokerage accounts, and rebalancing in your retirement accounts. Things, certain sectors or allocations may have been overheated a little bit. Now you can take this opportunity to reposition yourself.
Yeah, or we'll be working till 80 years old, Brian. There are some areas in the market that have been working. I mean, gold. You can't ignore gold. I mean, it's just been, talk about outshining, pardon the pun, but that really has been, an outperformer in this market.
Yeah, as Preston said, it's, diversification is so important. Not every sector is going to continue on and always outperform year in and year out. And so that reweighting is going to come. And, gold is, gold, if you go back, the 15 worst quarters in the S&P 500, 12 out of those 15, gold was actually positive. So it's a good non-correlation kind of asset to have in the portfolio to limit the volatility. Now, that said, gold's been up over 50% from the lows of February of last year. So we are seeing a little bit of a pullback right now around that 3,000 level. Typically, you don't see that kind of strong moves in such a short period of time for precious metals. But, so diversification is certainly key. The insurance brokers here, we're looking at the S&P insurance index, and that is only about 6% from its 52-week high, or down on the year. So, it's a relative outperformance down on the year, but it's holding in relative to, say, other groups. Now you can put that in the defensive bucket with staples and utilities.
Which is interesting. I mean, you like insurance, and after, all of the insurance stories that we heard over the past year with, fires in California and, the hurricane issues in Florida, you would think that they would have been under more pressure unless they were anticipatory about this and just right-size their models. I'm kind of surprised to hear that it was insurance.
Yeah, I think they have a lot of inflows. I don't know the industry too well.
Yeah, I don't know the industry as well either. I'm like trying to think out loud here, but
I still pay my homeowners insurance.
I know.
And it's gone up a lot.
Well, I was going to say, that's true. All of our insurance has gone up.
Taxes.
It's, we just don't really talk about insurance that much. It's not like, the sexiest of areas to speak in. But from Brian, from your perspective on the Markets Intelligence Desk, you're speaking to Nasdaq listed companies all day long. What are you hearing? What are they concerned about with this market volatility? Or are they kind of like, okay, it's happening everywhere, it's not specific to the company? How are they digesting this?
So I cover the financials and and the SPAC sectors, and so relative to their own stock, they're interested in where the selling is coming from, but it hasn't really been a tough conversation like we can have if it's a one-off company seeing price action to the downside. If the market's up 2% and a bank is down 1 or 2 or 3, 4, 5%, they want to know what's going on there. Why aren't we performing with the market? With everything being sold off across the board, very little companies now are trading higher in the last month or so, especially the last week. We actually haven't been that, quote unquote, crazy with the incoming calls and concerns and questions. I think people understand, what's going on. I think the banks themselves are concerned about their customers and what are they doing? Are they seeing the need to maybe not invest, maybe, push off those decisions on hiring or CapEx, things like that. And so I think that because everything is so recent with this, tariff announcement from last Wednesday, Liberation Day, I think there's some time to see how this all plays out and what the responses are globally. And it's hard to, to put much confidence or anything of a strong degree into what politicians around the world are going to be doing and how they're going to be responding, and what the actual true goals are. The economic goals or the statecraft goals really focus more so on foreign policy or national security. So there's a lot of uncertainty.
Yeah, there certainly is. But we're going to end this on a silver lining here, because yesterday was a bit dramatic for all of us. COVID is not that far away, and some investors, hopefully they understood that these downturns always allow for opportunity. And look at that almost, I'm saying, can't believe it's generational opportunity just 5 years later. But if you stayed in or if you bought at the lows, I mean, this could potentially be one of those opportunities.
It could be one of those transformational. I know we're using these big words, but it is. I mean, Dad, thank you for letting me bring my wife and son here. He's 11 months. I mean, we were buying all day long. I mean, because it is generational. It's good entry points 10, 20 years from now, even perhaps 5 from now. right? I even, my parents are clients of mine. They're in retirement, and so they had a little cash on the sideline. So they have enough bonds in their portfolio, but they're trying to outpace, outliving their money. So we picked up some things on sale, and they're in retirement.
Yeah.
So it can be. I know we're using big words as far as just on one side, as far as negativity, for our unprecedented tariffs, this, that, and the other. On the other side, it can be transformational and generational as far as an entry point and letting your investments be long term.
I do the 529 plans for my nieces and nephew. My niece, when she was 6 weeks old, so we're talking November 2019, got in and she got some really cheap deals, and her account is doing better than the rest of them just because of being able to acquire shares during the time of COVID in 2021 and 2022 when there was pockets of volatility there as well. So there are lessons to be learned from the little ones too. All right, appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.